Mirvac is essentially an urban asset creator, and we've undergone a significant transformation over the last 5 years. We have a very clearly defined purpose, which is to reimagine urban life. And actually on the 5 years note, the average tenure of an ASX 50 CEO is 5 years, and I'm constantly asked now that it's coming up to the 5-year anniversary, are you done? And I say no, we are just getting started. We have completely transformed Mirvac over the last 5 years, and we are now in a position where we can really leave a very significant legacy for our customers and on Australian cities. We've got a very sustainable business model, strong management team, $17 billion of assets under management, and a development capability that is delivering vastly improved returns. At a group-wide level, we delivered a return on invested capital of 12.4% last year, and that's significantly above our cost of capital of 7.8%. So we are delivering genuine security holder return. Each of our businesses, our office and industrial, retail and residential, is at the top of its class, and we've got great visibility of earnings for many years to come. And interesting, 4 years ago, investors would say to me, you can't be in three businesses, you can't be good at three things. You have to focus. And it turns out we can be good at three things. And I'll talk briefly about each of our sectors, but they're each independently at the top of their class against their peers in Australia. Balance sheet's in fantastic shape. We've provided very strong distribution growth and a low payout ratio, and we expect that we'll be able to continue to do that into the future. Overall, I say actually we've never been in a better financial position. We've never been in a more engaged position. Our staff engagement score is 88%, which is significantly above the global high-performing norm. And that is what is actually driving these results. So as you listen to how we think about markets and what we're delivering, think about the people of Mirvac and their passion and commitment, which is delivering these results. Because none of this success or future growth actually is possible at all without the very passionate and talented people of Mirvac. And sustained employee engagement is the single biggest predictor of business performance. It's something that you should want to know about every company that you invest in, something you should want to know about every company that you work for. So 88% is 3% above the high-performing global norm and 9% above Australia's national norm. And this provides us an exceptional platform for continued performance. And we believe that how we deliver is as important as what we deliver. And we continue to invest in areas which enable our business: safety, our award-winning innovation program. We put significant investment into people and leadership, into technology and sustainability. And we're very proud to say that we have been named the world's most sustainable real estate company by Dow Jones, which is quite an honour. But what is it that makes us unique? As a creator, owner and manager of Australian urban assets, we are deeply driven by our understanding of customers and of cities. We're very committed to our urban focus, particularly Sydney and Melbourne, where we have 75% of our capital, but we do have a thriving business here in Brisbane, which I'll talk to. Sydney and Melbourne are very important for Australia at the moment as we come off the post-mining boom construction era. The GDP growth in Australia has really been taken up by knowledge economy in Sydney and Melbourne, and it's supported by very high population growth. They actually account for together 2/3 of Australia's GDP growth and 60% of all net job gains in Australia in Sydney and Melbourne. In Sydney, it took 30 years to get Sydney from 3 million people to 4 million people. But it's going to take 15 years to add the next million. So the rate of growth is exponential. And Melbourne is growing even more rapidly. Do you know, a city the size of Cairns lands in Melbourne every single year. And it really does highlight the stress that puts on our cities. With cities growing so rapidly, the infrastructure lag that exists, particularly in Sydney, having that kind of population growth and what that means for nurses and firefighters and policemen and schools and hospitals, not to mention houses, is a really significant challenge, I think, for companies like us and for politicians of all levels to grasp how we can make these cities not only big, but also livable. We are a proven asset creator, and that's one of our key points of difference. We create assets across all of our sectors. And what we really like is when we can bring those asset creation sectors together. So when we can do mixed-use urban regeneration and bring our different sectors together to have a real impact. Essential to our approach is a disciplined approach to allocating capital into our urban markets, and it's driving very solid returns. We've got a very high quality investment portfolio that's driving a very secure yield. That underpins our distribution, which has been growing solidly, and in fact we increased our distribution guidance this year up to 6%. And our development activities provide growth. So think of us in those two ways. There's a secure yield and there's disciplined growth. And this is quite a unique model. 80% of our capital is in our investment portfolio, 20% allocated to our active business. One of the hallmarks of Mirvac's approach over the last 45 years has been an integrated in-house approach. We consider very carefully which parts of the value chain we should control in-house, where we should outsource, and where we should use a hybrid model. We are differentiated amongst our peers by having an end-to-end range of in-house capabilities, including design, sales and marketing, leasing, engineering. We build for ourselves, we don't build for anybody else. There's a whole range of how we're driving value to our customer controlled in-house. And I would say also that being the developer-owner of assets means that we make different decisions in the development phase than you would if you're a developer-seller, because we're thinking about how that building is going to perform for its customers for the long term. So what is this disciplined, focused urban strategy around asset creation actually delivering? So you will know that in FY17 we delivered EPS growth of 11% and 5% DPS growth, and we've guided to 6 to 8% EPS growth this year with 6% distribution growth. We put out our first quarter update yesterday, all tracking exactly where we expect to be. What is really pleasing is the returns in our residential development business have increased dramatically from 4% 5 years ago, now up at 18%, where we expect them to remain. So let's turn and look at office market conditions to start. So in the office sector, we all know there have been very strong levels of rental growth in Sydney and Melbourne. This is expected to continue. Vacancies tightening. We're seeing maybe in Sydney we'll get down to a sub 4% vacancy, which I don't think I've ever seen in my career. Sydney is a story of stock withdrawal, and Melbourne is a story of net job creation. Significantly stronger net absorption coming out of Melbourne than Sydney, and there's a clear reason for that. It's half the price. It's half the price for office, and it's half the price to buy a house. The employment pools are basically the same, so if you're a company with a presence in both cities, very logical why you would be growing your Melbourne presence at the expense of Sydney. But this is driving very strong net effective rent growth. In Sydney, that's up around 30% at the moment, 17% in Melbourne. We've got 82% of our portfolio in Sydney and Melbourne, so well placed to capture that upside. Brisbane, I'm sure I don't need to tell you, there are signs of recovery in Brisbane with improved tenant demand, which is very good to see. And even in Perth, we've got some positive net absorption, although incentives still hovering around 50% in Perth, which makes it a very challenging investment proposition. But we have had in Perth 3/4 of positive net absorption, and that tells me that jobs are coming back to Perth, and we see it also in the housing market as well. We've got 3% of our portfolio here in Brisbane. We'd like to have more. We're trying very hard to get a development to work at 80 Ann Street, where we have an option if we can find a tenant. The real key to our office and industrial portfolio is this asset creation story. And over the last 5 years, we've divested out of suburban assets, and we've focused on creating a prime portfolio of CBD assets. And our reasoning is quite simple. When you come to the end of a cap rate cycle, which we believe we are at, where you do not want to be when that cap rate cycle turns is in secondary assets. Where you do want to be is in young, low capex assets that are suitable for how customers want to use space into the future. And so we've got $2.3 billion worth of committed commercial pipeline at the moment, and that's going to deliver $90 million worth of additional NOI out to 2021. About $150 million of development profit, another $250 million of uplift on our balance sheet. But those aren't the important metrics. The important metrics is what it does for us in the future. When the cap rate compression cycle ends, and I'm not a believer in the this time it's different, every time someone says this time it's different, you should worry. When that cap rate compression comes to an end, that's been an investment thesis which has lifted all boats. In the next phase, income is going to be king. And having buildings which are significantly lower cost to maintain because they're young, and are buildings that are how people want to use space as a strategic element of their business, that's exactly the type of assets that we want to have. So let's turn to the retail sector, and we were talking at our table over breakfast about the retail market. There's a lot of discussion about what's going on in the retail market, and there's no doubt the retail sector as a whole is facing headwinds due to lower wages growth, increase in online retailing. But urban-based centres in Sydney, where we are predominantly focused, are well supported by economic growth and large infrastructure spend and strong population growth. So let me unpack a little bit about how we see retail. People talk about the shift to online shopping. We believe it's certainly not a one-way street, and that it is all about the differentiation of experience. So an online transaction, that is, it should be a frictionless, no experience transaction. That's what it's designed to do. That's why it's such a powerful customer proposition. Shopping in a shopping centre should be an experience. And people go to shopping centres for a whole host of reasons, not just to transact. They're going because they want to get the kids out of the house. They're going because we've got good Wi-Fi and they're studying in the food court. We've developed a thing called Shopping Nanny, where you can leave your child with a qualified nanny free of charge for 2 hours while you go shopping. Here's a very interesting statistic for you. We've been trialling this in some centres, including Orion, here in southeast Queensland. And we found that the average spend of a shopper going to Orion is $48. The person who leaves their child with a shopping nanny for 2 hours, they spend $202. So and it came out of our innovation program, Hatch, where we were looking at pain points for our customers. So what we're trying to deliver is this experience. So people going to malls to eat, people going to malls to socialise. Think of it like an urban living room. That's how we're thinking about what retail should be. And it's driving really different results in our portfolio. We've got very strong metrics right across the portfolio. Whatever metric you would line us up against our peers, whether it's occupancy cost or MAT growth or spreads, we are right at the top of our class. And if you looked at, for example, comparable MAT growth, our comparable growth for the quarter was 4%. If you strip us out of the REIT sector, the average of everybody else is 1.2. So 4 plays 1.2. Our leasing spreads of 3.2%. If you strip us out of the basket, everybody else is at 1.5%. So why? What is it that is driving these completely different retail results, which seem to fly in the face of the tailwinds, the headwinds, which are certainly affecting the retail sector? And if head of retail Susan McDonald was here, she would give one of her favourite sayings, which is to say that not all retail is created equal. Our bespoke urban portfolio is focused on catchments with demonstrably better characteristics. They are growing 65% faster than the average. They are 10 times more dense. They've got 21% higher income per person and 27% lower unemployment. That is a lot of people earning a lot of money, living in apartments, who go out. And we've remixed our assets to focus on the needs of those urban customers. We've got no department store exposure. We've decreased our discount department store exposure. We've got higher food and beverage and higher non-traditional retail. And we very much believe in the retail world of the less is more school of asset repositioning. And we try very hard to create as little space as possible to create that experience for our customers so that we keep demand high. And we do deploy our asset creation skills and repositioning skills into our retail portfolio. Broadway, some of you might know, it's a shopping centre in Sydney. It's Australia's highest performing productivity shopping centre for 5 years in a row. And we redeveloped a grand total of 8,500 square metres, added a few square metres, but not many. And just redeveloping that area using our asset creation skills, we've seen a 4.1% increase in foot traffic and a 31% increase in specialty sales. And it's all about focusing on what is the need of the customer in the catchment of that urban centre and how do we remix according to that. There's no cookie cutter formula to retail. It is very bespoke. Some of you might have been to our newest edition tram sheds at Harold Park in Sydney, a completely unique retail asset which is redefining what institutional retail is all about. It's been open for 9 months. It's already won 6 awards and is approaching $10,000 per square metre in productivity. Of course, I talked about Orion that we have here in Queensland, a very successful expansion done there. And we've actually just embarked on the expansion of Kawana in the Sunshine Coast, and we're steadily repositioning Toombul, which we bought a year or so ago. But most exciting from our portfolio point of view is the Harbourside Shopping Centre in Sydney. And if you can visualise Darling Harbour, it's completely regenerated, billions and billions of dollars put into Darling Harbour. Right in the middle is this beautiful 1980s copper roof shopping centre. And we actually get the opportunity to demolish it. and we're in the final stages of negotiating with the New South Wales government, and our plan is to demolish it, put in a $1 billion redevelopment of a shopping centre that actually is fit for purpose and does sit beside the convention centre and all of those hotels being built there, and with a residential tower on the end, which will pay for the entire demolition of the shopping centre. So $1 billion development, very exciting to be getting on with that. So finally, I'm going to turn to the residential market overview. And I don't need to tell you, every single day you read something in the media, usually contradictory and on the same page. We hear housing affordability scrutinised, unpacked, repacked, solutions proffered, rejected. Politicians of all persuasions, economists, not-for-profits and corporations have something to say on the topic of Australian residential often. But it's really important to recognise there is no one Australian residential market. There are significant differences between cities, between regional towns, and indeed within cities. You cannot talk about the Australian residential market. So let's look at what's happening in some of those markets. Sydney is finally easing in its price growth, which is very welcome. Now, we thought this would happen a year ago. We were wrong. We had strong double-digit price growth again, and it's just unsustainable. You can't have high double-digit teen growth in a market year after year after year without causing significant housing stress, and that is extremely bad for the livability of our city. So finally, Sydney is starting to go down to the low single digits, which is very welcome. The pace of price growth is a little bit stronger in Melbourne, so supported by that very strong population growth, which is the highest since the 1960s. And I was really astounded to learn when we did the most recent census that the Victorian government had been miscalculating the number of people in Melbourne by 143,000. There were 143,000 more people in Melbourne than they thought when the census was taken. Vacancy rates continue to be low in Sydney and Melbourne, and we think Sydney and Melbourne can sustain above-trend completions, in fact need to sustain above-trend completions for the next several years to keep pace with that strong population growth. And I think from a society point of view, this is a real challenge. We see in Sydney, in particular, there is a strong push away from using the infrastructure investments that have been made wisely around density. There's significant push from people in Sydney and Melbourne that we should be not increasing density in our cities, but we can't afford to keep sprawling our cities. So it's a very big political challenge, I think, how we actually complete enough stock to keep pace with population growth, which is driving our economy, and also maintain livability in our cities. Brisbane and Perth, moderate price growth. We're continuing to see slower sales than we would like in some of our developments here in Brisbane, but we are seeing sales. Default rates are reasonably low. But what's important in Brisbane, I think, is that construction starts and approvals have come way off. And that's important because there was a point where it was looking like a very significant oversupply was building in areas like Fortitude Valley. Construction costs at one point were running at an inflation of 15%, which is very difficult to manage from a business point of view. That's come back off as the construction starts have come down. So I think that's much more healthy from the Brisbane market's perspective. There's always a lot of talk about the stretched Australian household, and certainly high levels of headline debt will capture the headline. But if you unpack that a bit and look at the net debt position, Australian households are in reasonable position, and certainly no worse than they were in the early 2000s. In fact, the average Australian household is approximately 3 years ahead on their mortgage repayments, which gives a really strong financial buffer. So we do expect the Australian housing market, if you can call it that, to continue to be supported strongly in Sydney and Melbourne by population growth. So let's look at where we see our portfolio in that context. We focused on the right markets at the right time, and we've been very responsive to the cycle. In fact, in FY11 to 14, we restocked the portfolio very well, bought some very significant sites, including Greenbank here in Brisbane, which we're looking forward to starting marketing next year. And then we turned off the tap. We could see that price growth was escalating and that sites were, with significant planning risk, were being able to be sold for cash to a foreign developer, and we stepped out of the market. But at the same time as stepping out of the market for new stock, we accelerated our releases. So we effectively doubled the production in the business from an apartment perspective in particular, and to try and capture the demand in the market. So our Sydney and Melbourne overweight is going to allow us to capture the uplift that's going to come from that transport infrastructure spend. And so this chart shows you around Sydney, that's the Melbourne Metro, and these are some developments that we've got targeted specifically around around those areas. And I do hope that there is a sensible conversation that can be had with councils and state government around how we leverage the infrastructure spend that the state government has wisely done to make sure that we're getting the right solution from a citywide point of view. So all of that has come together to mean that we delivered a 54% earnings growth in residential in FY17. That comes off 50% the year before as well, and a return on invested capital of 18%. Our gross margins have significantly improved, up from 17% to 24%, and they will continue. And they'll continue even without price growth. We don't build price escalation into our feasibility, so we're not dependent on price growth to get continued strong margins. Had very strong sales activity in the first quarter, very high level of secured pre-sales, $2.8 billion. That means that we can see for years where earnings are going to come from. And settlement risk, that's one of the topics which is in the media frequently. It was going to be Armageddon apparently a year ago, but defaults are under 2% and have been for the last years. So it's very, very normal. We're expecting to achieve a record level of lot settlements in this year, and a very significant skew to the second half. It seems to happen every year, and it does put pressure on our teams towards the end of the financial year to achieve those settlements in June, where there always seem to be a lot of them, but we always manage to do it. In fact, at this point, we've got 80% of our EBIT already secured for FY18, so a very, very secure position. In terms of our customer base, we're seeing an increase in first home buyers, which is very welcome. An increase in domestic investors and a slight decrease in foreign buyers, which is not to be unexpected given the capital controls in China. So if we look forward, we've got over 30,000 lots in our pipeline, evenly balanced between apartments and master plan communities, and 50% of our lots have an embedded margin over 25%. So in the future, what can you expect from us? Really, I think the answer is more of the same. We are passionately committed to Australian cities. We believe that we've got a big legacy that we can leave, particularly in mixed-use urban regeneration. You can expect us to keep focusing on the urban strategy, to keep focusing on growing our earnings and our return on invested capital, to focus on increasing our distributions at around 6%. You can expect us to continue to be prudent around the cycle. I think we've demonstrated that we've been very disciplined around the residential cycle, and on the investment side of the business, we have definitely not been the buyer of the stabilised, shiny core, low cap rate assets, preferring instead to be the developer of those assets. You can expect us to continue to have a very conservative balance sheet, making sure that we've got capacity for future opportunities. We're going to keep building out our development portfolio, and we're going to keep working with our capital partners. But underpinning all of that is our continued focus on our customers, on innovation, on sustainability, leadership, technology and safety.